And thank you for joining us today. Some of you may have already heard a little bit about the budget announcements, but interestingly enough, I think I heard comments like uneventful budget, not tax technical, and it's very much a pre-election budget. And also a lot of the measures are temporary measures. So yeah, so that's the general sort of feel the budget. I think the focus areas were about generally, not necessarily tax, but it was creating jobs, cost of living, and we'll talk about cost of living, strengthening the regions and the infrastructure, road and rail, and I think Todd will talk a bit about that, essential services like the COVID, Moderna factory going up in Victoria, etc., and defence for obvious reasons. So I think the winner or winners is the new skills and training boost for SMEs, small to medium businesses, and new technology investment boost. And I'll discuss them in a bit more detail in the presentation. What's missing though? I think the sort of mentioned the structural tax reforms, which tax people love, long-term change for our tax system. I think there's missed opportunities because there's a lot of temporary measures. And if you think about it, every time a temporary measure comes about, we have to do a lot of training to understand the rules, and then clients themselves have to implement systems and understand it. So a lot of work goes behind these temporary measures, and it'd be nice to see some of these temporary measures being made permanent measures. And I'll talk about that as I go through it. Also, climate change. Not a great deal about climate change, given that we want a net zero emission by 2050. There's no plan or measures really in this budget. That could come down the track. There is something on farmers, carbon credit sort of thing, but other than that, not really. There's been a lot of news about cryptocurrency, but nothing in the budget. So that's why I call it a quick fix and one-off measures. So cost of living, I think these are the things that usually come into the budget, you'll see, and this is more of on a personal level. Will it affect you? I think there's nothing in the budget really for the higher income earners. And as you can see there, these measures, the tax cut announcements, were already made prior to this budget. And the big one that's going to come in 1 July 2024, assuming nothing changes, if a new government comes into play and doesn't change it. Well, I see the big one being 1 July 2024, when the next personal tax cuts are coming in, which will be that, the 45 cents in the dollars, the highest tax rate will be when you're earning over 200,000. So that'll be a bit more substantial, I think, for some of those earning in those tax brackets. But that's not in play yet. It is legislation already. So that wasn't in the budget, but I just thought I'd mention it because I think that will be a big hit. One off 420 cost of living offset, the low to medium income tax offset, they call it, LIMTO or Leamington in some cases. Look, it ends at the end of 2022, and from 1 July 2022, there's your normal progressive rate of tax, and this was implemented. It was a 4-year sort of implementation for those kind of earning under that 130, 129, and it's an offset. Now, the thing about the offset is you don't really see it. So it's not cash back or anything. You have to lodge, well, one, you have to be paying tax to get it because it's an offset. And the other is you have to be lodging. It's when you lodge a tax return, you get it. So if you're not paying tax, then you lose it. And if you're not getting any cash, probably not going to be relevant for a lot of people, but there are many that will receive that. The reduction of the 50% of the fuel excise. As you can see, fuel prices have been very high. 50%, so what is it now? It's 44 cents in the dollar, 44 cents, yeah, per litre. And they're reducing it to 22 cents in the litre. Now, that's all type of fuel, unleaded, what's the other one? Diesel, etc. Now, it's only for 6 months to implement this measure, so till September 2022, and you can kind of see it's already taken effect. So this is an example I've used from someone else, which I thought was quite good, so I'll use the example. Thank you very much. So New Year's Eve, unleaded, 148. budget night, it was 188, and in some areas, this is an average, I'm sure in some areas it was more. Friday, after the budget, it was 160. And what is it today? I don't know, because I've got an electric car. And on that, there was nothing about electric cars. So, yeah, so you think they'd be pushing people to get more electric cars.
But
Well, it might
Maz,
push you to, yeah.
some of that changes because the Australian dollar's strengthened as well at the same time, and supplies come online. So it's not only the government's given that for a short time, but it hasn't been the sole influence of that change in price.
Yeah. Thanks, Todd. I'm not an economist, but I'll agree with that. One-off payment, $250, so pensioners. So if you've got any parents out there, anyone on some disability insurance, disability Centrelink payments, anything like that, there's a $250 one-off coming in April. I'm not sure what $250 will buy you, but, you know, it's there. And that's extension to the temporary reduction in the minimum pension drawdown. So this is basically, the legislation is already in play. It's a regulation, so this is an easy one to implement, and that's just going to go for another year, those that are on the pension. So just cost of living measure, that's what it was focused on. I'm just going to move my little thing around. Just for the corporates, I thought there was an extensive amount there for the corporates. And when I say corporate tax, I mean, there was stuff on the patent box. I don't know if you recall, last year there was talk about bringing out a patent box. What is a patent box? Patent box is, if you know, sometimes organisations carry on R&D, so research and development to develop a new product, be it in the medical field, be it in agriculture, manufacturing, software, etc. And, you know, people do the R&D, and then what happens is we develop the IP, and what happens, it goes overseas because we have the investors overseas. That happened to Latvian is one good example, and many more. So what the Australian tax, or the government, I guess, is trying to implement is a patent box. And what it does is corral the income from that patent. So the R&D that you develop in Australia, and you may have a patent on it, effectively corrals it into a lower tax rate. So 17 cents in the 17% effectively. Now, it was only proposed to apply for medical and biotechnical innovations from 1 July 2022, and there's a start date for the actual granting of the patent, sorry. So it may be, say, 11th of May 2021. Now, they've expanded that in the budget. So they've actually expanded to say that they're going to include agriculture and low emission technology from 1 July 2023. But that's all they've expanded it to. That's great that they've expanded it, but it'd be great if they could expand it even further. So that's about keeping the IP in Australia. Now, what gets taxed at that lower rate? It's really that type of income stream that comes from it. And I don't know the detail because it hasn't really come out, but anything to do with the patent income would come in at that 17 cents in the dollar. So it's interesting because what you're going to have, unless you have a separate entity collecting that money, what you're going to have is you're going to have some income at 17 cents in the dollar, some potentially at 30 cents, or some potentially at 25 cents, which is the new tax rate for corporates that are aggregated turnover under 50 million. We have that 25 cents in the dollar.
So Maz, will that lead to a rise of IP entities where they'll park IP in that sort of structure?
Potentially, yes. But, you know, again, that's what it's trying to do. It's the medical, biotechnical, in 1 July 2022, that's right, and agriculture and low emissions technology, but nothing else. So you have to fit, at the moment, you have to fit the legislation in those areas for it to apply. But interestingly, the medical and biotechnical innovation goes hand in hand. It's not a budget announcement, but it's something that Oz Industry have been working on, is regulating that any clinical trials that you're doing R&D on will automatically be core activity. So if it fits the criteria, you still would do an application, but effectively, you know, they're not going to question it so long as you've got all the evidence, obviously. So it fits in with that medical bio. So you do the clinical trials, you eventually get something that you produce some sort of product, drug that you might sell, cream, who knows what it is, and you patent it in Australia and keep it in that entity that will have that income stream and taxed at that lower rate. It's, you know, patent box is not new. It's already in many countries. And I know some companies that have taken their IP overseas because, you know, UK offered patent boxes, which Australia didn't have at the time. Now, given the circumstances now, I think they would have done the same because the area that they're working on isn't one of these areas. So it's a bit narrow, and hopefully they'll expand that. The other area for corporate is the employee share plans. So if you know some of the startups, innovative entities, even the bigger ones, they offer employee shares. Now, there's employee shares for listed entities, and I'm talking specifically for unlisted entities. So if you offer employee shares, one is, you know, you get all these startup provisions and there's some incentives there, and it makes it easier, cuts through a bit of the red tape. What they've introduced here is under the Corporations Act, in order for you to offer unlisted shares, you have to make sure you fit certain criteria. And there's a whole list of them. But one of them is that the value of the shares can be no more than $5,000 per employee. Otherwise, you have to get a financial services license, like you're raising money, if you like, or giving shares away. So I think that what they're proposing here, the change is that it's going to increase it to the value of $30,000 per person, or in 5 years' time, $50,000. Now, I don't know the detail, I haven't seen that, but that's more of a corps law change. So the tax law hasn't changed. It's just freeing up what you can offer staff and up to a certain value. But the tax law, you can still apply the startup provisions, which means that you may not pay any tax at all.
Yeah, and Maz, that's the big thing with these sort of employee share schemes, is making sure that you're not creating a tax issue, that people need to sell the shares or realise some other assets to then pay to keep the shares that you're giving them as an incentive, and creating more complexity. That's
right. And I think with all these employee shares, I think it's two things to always consider. There's the tax consequences, and that you may get out of under these startup provisions, or they may not be of value once you've had a valuation. And the second bit, it's not just the tax you need to consider, but the legal side of it, the Corporations Act. So that's why we always have the lawyers look at them.
It's a number of areas where we see disputes arise at different stages when people leave with a significant shareholding or something and create havoc, or at least a distraction from what should be going on.
Yeah, and it depends what type of plan. So, I mean, you could have an upfront taxing, you could have a deferred, and out of the deferred, you could meet the startup provision. So it is a bit of a complex area, but again, it's one of these, if you are offering employee shares, it's one to keep in mind, and you are an listed entity. So the legislation isn't out yet, but it is something that, you know, it is worth remembering.
And it is getting more common as people look to lock in key employees longer term with these sort of incentive structures, because that's part of the problem at the moment is keeping hold of good people is difficult.
Yeah, especially startups as well, or, you know, entities that are raising capital and they've got good people. They know this is, you know, what they're developing is going to prosper. Well, everything's a gamble. Once we have more legislation on this, obviously we'll have some sort of, you know, email out to clients and more information on it. So the SME is, when I say SME, we call them small to medium enterprise, and that is with the aggregated turnover of under 50 million. So if you're over 50 million aggregated turnover, none of this applies to you. So you have to go to whatever other areas are available, and I'll go through them after this. So as I was saying before, one of the key wins, I guess, is the skills and training boost. It only is applicable for a certain amount of time, and that's from the 29th of March, budget night, until the 30th of June, 2024. What it gives you is an extra 20% extra deduction. So if you spend $100, you get $120. So that notional deduction, if you like. It only applies to external training, not in internal training or on-the-job training. So must remember that, external training. We don't know if it's external trainers that have a, you know, like must be registered trainers, We don't know the detail yet, so that is yet to come. That is not already been drafted, the legislation for that. Applies to employees. We need to confirm it if it applies to contractors. So at the moment, it's employees. That's all it says. You claim 120% of the cost of eligible training. What is eligible training? Comes back to external training, but the detail is yet to come. Only available to small businesses with aggregated turnover of less than 50 million. When I say aggregated, you don't look at yourself as in your own entity. You look at the entities that you're connected with. So if you're foreign owned and your foreign entity is making more than 50 million, then you're out, even though you may be making less. So it aggregates and they control you. If you're an entity and you have a couple of subsidiaries and together you have under 50 million, perfect, no problem. So always look at your structure. You probably already know this in some sense when you're doing, you know what your tax rates are, etc. Give you a good indication. The only thing about it is that because it was brought in just now and 30th of June is just coming up, I don't think the ATO is ready for it, so they don't have the stationery. So what they're saying is if you incur an expense from now to June, and assuming it's eligible, because again, we don't know what it is, but it's an external training, then that you can claim the deduction in the 2022 year, but the boost you get in the following year, because I don't think the software allows you to do it. So if your expenditure is in 30th of June 2023, meaning 1 July 2022 to 30th of June 23, or is it 1 July 24 to 1 July 2023 to 24, there you can claim it all in that particular year that you're spending it. So you claim the expense and the boost. It's just an oddity of the first year. So again, when more information comes out, we'll be sending out information to our clients. Sorry, Todd.
That's a great opportunity for accountants everywhere to help their clients.
Yeah,
and
yes,
recover
it is,
a bit
Todd,
more money. And once you get some clarity, but that would make more sense from what they're trying to do is grow the economy at the base up.
That's right. But the only thing I see with this is that it's a temporary thing. It'd be great if this was permanent. That's what I'm saying. You're going to spend a bit of time. Professionals, even clients, are going to spend time to understand it. And then it's only here temporarily. I mean, if the current government stays in play, who knows? Maybe they'll keep it. But again, you know, they're giving you an extra 20% deduction. Now, you think about some organisations do enormous amounts of training. I mean, we do a lot of training. So, you know, 20% boost is nothing to sniffle at. And it's a notional deduction, meaning, you know, it'll be an extra bit that goes in your tax return. So with the skills and training boost, there was another technology and investment boost. Again, trying to get businesses to become more tech savvy, if you like. Also, this measure comes in 29th of March 2022. The only difference is it's there till 30th of June 2023. So it's not as long as the training boost. It's the same concept in the sense that it's 120%. So you spend $100, you get 120. They gave some examples, and this is only from the budget night examples. So everyone's going to use the same examples, but it's portable payment devices, cyber security systems, and subscriptions to cloud. Now, I can't imagine subscriptions to cloud would be a yearly annual subscription to Xero or any of those, SAP or things like that. So I don't really know what that means, besides that was written in the budget. There'd be an annual cap of 100,000 in each qualifying income year. We think the cap is for the boost amount, not for the total spend amount, but we just need to confirm that. Again, it applies to small business, so your aggregated turnover under 50, which is not really a small business, but you know what I mean. It's more targeting most businesses, not necessarily those overseas business owned. Again, the first year will be the same. You claim 100% in the first year, and then the incentive in the following year. It's just an anomaly for the first year. Anomaly. And we're still waiting for the legislation. Also need to consider, because this is technology and investment boost. So, you know, a portable payment device, cyber security systems, it depends what it is. How does it fit with the temporary full expensing provisions, which are still there until 30th of June 2023? So that's something we'll consider when we have the detail. The devil's always in the detail, as your tax advisor would always tell you. So what's already in play, which isn't part of the budget for your SMEs? So you're sort of thinking, well, what do we do have? Well, you know, your tax rate gets reduced from 1 July 2021, so long as you meet the turnover test. They call it the base rate entity, is 25 cents in the dollar. So it's not too bad. That's pretty good. But remember, your franking credits go down as well. So when you're paying dividends, it's going to be based on 25, not on 30, even though the dividends may have been paid at 30 cents in the dollar, or the tax, I would say. So the temporary full expensing measure, which came in 6th of October 2020, last budget time, the instant write-off, basically. So this was a really great incentive, still is, still there, for turnover of less than $5 billion. So pretty much you can use it, right? There are some businesses that we have that, you know, are foreign owned, and the foreign owned are pretty big, and the 5 billion is met, so they don't get this. But it's, for most businesses, we will be receiving this, and is still available 30th of June 2023. Now, there's no cost limit to it. You can claim anything you like, except, of course, cars. You've got to remember there's a base, because this is a common question that comes up. There's a limit to what you can claim on cars, and that is the 60,733. That still applies when you're looking at it from this temporary write-off. So don't go and buy your Ferrari, Maserati.
But that doesn't cover a ute though, a corporate ute though, Mariana, does it?
It's a car. So if it comes within that definition of car, yes. So
so with potential inflation coming along, if you can get equipment and whatever else now to be able to utilise this may be a good way to apply it and get the costs down straight away before rates go up.
That's right. I mean, 30th of June 2023, that's right. Your low interest rate at the moment. 2023, it cuts out supposedly, and this is what we're talking about. These temporary measures, could we extend them? Because I think they're good for business. Some businesses can't afford to buy anything, so it's probably not even relevant for them. But those that can, fantastic. It excludes buildings, by the way, so you can't go and buy a building. So you do get asked interesting questions, but you know, it's good because people are thinking about it. The other measure that goes with the temporary full expensing, and it's known, there's nothing unusual about it, is the carry back of tax losses extended to 2023. So, you know, you can successfully use these two together. And some of you already know this, for those that, you know, haven't thought about it, if you're claiming, you're deciding to buy some assets, it's going to, you know, go to your P&L. So you're going to get a loss potentially in that year. And if the loss is made in that 2020, 21, 22, 23 year, you can take that loss back to any income year you had. So if you had an income in 2019, you can take that loss back, and effectively, if you've paid tax in any of those years, depending on when your loss falls into play and when you pay tax, you can actually get your refund back. So we've actually been getting some refund back for some of our clients. And that's a successful way of buying stuff today with tax you paid in the past. There are some criteria around it. So, you know, you have to have your franking credits available, etc. But that's just a matter of looking at each individual circumstances. But majority clients are able to meet this criteria, not necessarily impossible to meet. So other measures that were in the budget, some would apply to all, but with the primary producers, this is probably specific to farmers and those that, and it is probably one of the only measures that is more like climate change, and it's about the carbon abatement activities. Now, I'm not so familiar with this. I haven't dealt with it. It applies from 1 July 2022, but my understanding is that proceeds from the sale of Australian carbon credit units and certificates couldn't be treated as primary production income in the past for the purposes of farm management deposit scheme. and tax averaging, and from 1 July 2022, they will be able to be used or be classified as primary production. And I think another great point was the taxing point for these Australian carbon credits. It'll change to the year that's sold, so it aligns with your expenses. I think this is quite a good measure for the farmers that are using it or will incentivize them to use it. COVID-19 test expenses, it's going to be made a deductible to employees. So if you bought some COVID tests and you're using it for work, so you're testing to go to work and you've been buying them since 1 July 2021 and you've kept your receipts, I didn't keep my receipts, but maybe I have a credit card receipt or something like that. You can claim that as a tax deduction. Now, because you can claim it as a tax deduction, if your employer reimburses you, there will be no FBT because it's an otherwise deductible. An employer probably couldn't get it under, and this is the nuances of FBT. The employer may not have been able to get it under the 300 rule because is it infrequent, regular and infrequent for the minor benefit rule? Because you're providing them every day, twice a week, or whatever it is. Legislation hasn't come out, but I don't think I don't think too many people care. But I think it's easy now. We can say, oh yeah, it's tax deductible, claim it, and no FBT.
So that'll be a new thing that everybody will claim as long with the working from home.
Exactly.
Allowance.
Yeah. Just make sure you got your receipts. I mean, look, in most cases, employers are paying for them. But not everywhere. If again, it's work related. So if you had to buy them for your kids, to go to school, I don't think that's going to be tax deductible because I don't think that's work related. Maybe for you, but not necessarily for the kids. So that's another question. And I think we'll wait for the legislation before I answer that definitively. Varying the GDP. So whenever you do, you pay tax 1 year, they sort of increase for the GDP, they increase it by 10% each year, the tax office, of what your instalments are going to be for the following year. So for the 2023 year, so that'll be from 1 July 2022. So you'll pay your tax in 30th of June 2022, you'll have a tax figure, and then they work out your instalments for businesses. And normally they raise it by 10%. Now it's only going to be 2%. Now, it's for businesses who do have PAYG for turnover under 50 million or for GST 10 million turnover. So you have to fit within those brackets. It'll automatically happen, which I think means you pay less. I mean, you could always vary your instalments anyway, but it's an automatic thing.
Gives a bit more working capital available for some of these businesses.
Yeah, that's right. More cash a quarter. I mean, as I say, you can always vary it. There's another good one coming out. I'll get to that one. The Tax Avoidance Task Force, I thought this was interesting. So they're extending the funding by $326 million or something. I can't remember exactly, but it's a big figure. And it was interesting because I think they've made something like, I can't remember the $1 billion. So this is where it formed in 2016 for large corporates. And then it's eventually, some of you in the high net worth individuals would probably see that, and also the larger businesses, SME businesses. We've had these focus on 500 private groups or the next 5,000. Some of you would have heard of those. Well, this is what it's basically going to have funding to target. So the ATO basically is funding for the SMEs, the trust arrangements. And what's been very popular and very hot in the news or in the tax area is all these rulings that have come out on 100A. And basically it's a trust, which is very common, at the end of the year you have trust distributions made and you get mum, dad, and oops, there's some few teenage kids there over 18 or just on 18 in the university, and you've got 2 or 3 of the little critters. And you think, okay, well, I'll just divide my trust distribution amongst them. Now, as most of you know, you make a profit in a trust, and where does the cash go? It may be mum and dad takes the money. Maybe it keeps it in the trust, but you have to distribute it. So if you distribute to, say, to the parents and the 3 kids, that's a known thing that's always been happening. Now, we've always thought that if it's for, family, if it's to do with family, that would be all right. But again, the tax office brought out a ruling saying that if you distribute a trust distribution to all these individuals, but the cash doesn't follow. No, sorry, the economic benefit doesn't follow. So cash never really sometimes follows. But if you think about it, mum and dad get the money, they get all the money. The 3 kids don't necessarily get the money. Now, there's always been a theory that, well, the parents are paying for all the kids, expenses, upbringing, etc. So they should be entitled to it. But no, the ATO is saying, looking at those kind of activities, you can still do it, but you just have to think about how it's done, and it's got to be done that you are actually paying for maybe the university fees, etc. So that's just something to discuss with your advisors.
From a non-tax person, Maz, that they just want to see the cash movement go through, so that there is something supporting it, so the distributions are real rather than.
Yeah, and I guess they kind of see it as the fairness. If you're sort of you're wealthy enough, if you like, to set up a trust, and you can then reduce your tax by sending it off to some family members, then what about the rest of the world, all the rest of the people? So they do talk about fairness. So the task force, it's really more about the task force, but what they're spending their money on and why they've increased the spend, because they're going to get more from the taxpayers. That's why. Other measures, PAYG instalments. Now, I thought this was a good one because these ones here are all really software driven. So your software providers will update the software, and when that gets updated, you'll automatically have this available. And I'm sure they'll tell you about it, but I just thought it was worth mentioning. PAYG instalments, currently it's based on, in most cases, last year's payment, and they make a quarterly amount. As we said, the uplift factor of 10% will go to 2. But now what they're proposing is from 1 January, if this legislation passes, 1 January 2024, so a long way away, because the software providers have to update their software, is that it'll be based on the current financial position, adjusting for certain tax adjustments. So you'll be able to do it automatically and calculate what each quarter your income is, and you'll pay tax on your financial. Now, you can opt in this, you don't have to do it, but that's an opt-in. The other is smarter reporting for your annual statements. So this is more to do with at year end, you've got some certain taxpayers that have contractors. So you'll have building industry, you'll have cleaners, couriers, and they have to report what they're paying their contractors. So what they're trying to do is bring in a more like STP, basically, that it's actually reported in line with their BASs. Now, again, this is coming out in January 2024, and it's dependent on the software providers being able to develop it. So instead of you having to do it on the 28th of August each year, if you are doing it, it'll be automated. So less thinking about it, but more information the ATO can get. Digitalized tax income returns, trust income returns. So basically, currently, a taxpayer can do an individual tax return, a company tax return without using a tax agent, but you can't do a trust return. So what they're trying to do is enable taxpayers to lodge their own income trust returns. And that's expected to start 1 July 2024. Now, that's fraught with danger, considering there's a lot of issues with trusts. One is people don't look at their deeds properly and ensure that what can they distribute. The other is if you look at those trust returns, they're not that easy to figure out. But if you did want to do it, so this would apply to funds, so unit trusts. So if a fund manager is sophisticated enough and they want to do it themselves, they can, and that will be available to them, assuming the legislation passes. The last one is enhancing sharing of single touch payroll data. So this is payroll, state-based, the interaction between state and federal levels, that's going to be digitalised again. And that is to do with more your interaction with payroll tax and your PAYG withholding, etc. So it's a bit more Big Brother being able to keep an eye on you. That's it for me. So over to you, Todd. Thank you.
Thanks, Maz. Sounds like there's going to be some more digitisation, which will assist everybody. So that'll be helpful and bring everything a bit more live in terms of the numbers. But yeah, that'll also mean the ATO will be able to ask you more questions on a live basis, some of the old skills will be lost.
You can't hide.
That's what they say about tax. In terms of winners and losers, so I've tried to look at it and dive a bit deeper into it. And there's obviously it's a large document. They don't print too many of them these days because they kill too many trees. But when you go through and look at it, there is lots of specific little allocations. But in terms of three of the larger industries that we deal with on a day-to-day basis at the moment, these are some of the winners and losers. So in terms of retail had a great February. March looks like it's been terrible. The weather obviously didn't help, but it'll be telling about what happens in this month and whether the momentum from February is going forward. Particularly, there's obviously issues in hospitality around consistency in turnover and things like that, availability of staff and working through those. There are lots of businesses operating very well in the retail space, but there are a lot that are struggling, and there's also issues around supply, which we'll get to in a minute. But there is that short-term release of cash to the pensioners, and there's also the income offset, which will free up a little bit more cash. And there's still obviously a higher level of savings sitting in the economy from COVID. Hopefully that gets released a little bit more consistently to keep retail spending going. However, it will be something to look at. Losses, there's still pressure on wages and limited solutions available in across a lot of this to be able to maintain workforces and keep consistency going. That may change slightly as overseas students and backpacker numbers come in, and that transient workforce can assist with dealing with that. In terms of overall, there's still concerns around the impact of the election and what factors result from that and whether that creates a downturn in confidence. There does appear to be a little bit of a hold sitting there now where everybody's waiting to see what happens for the next 6 weeks. But hopefully that gives everybody a bit more confidence rather than reduction in confidence. We'll have to wait and see. And then there should be some higher employment. Will keep some level of demand. So as everybody is employed and there's more money in the economy, people will need to spend more money in retail and across hospitality. So that should drive that. It may just be in specific niches which deliver very well and have been able to provide something that a lot of people are willing to look at. We see it in restaurants down here where there are a couple of restaurants which are fully booked 4 or 5 days a week, and there are other ones that are ghost towns some days and full other days. So that's just going to keep developing. In terms of freight forwarding, well, there's not many wins. The training and technology deduction may be of interest because I think there is a lot of work being done, and it's a lot harder to manage a lot of these the processes and the downflow of movements and all of those sort of things. So I think focusing on how to reduce the working harder and get a lot more out of just doing the same level, and that leads into the supply chain, the increased cost impact. Some of the feedback we've had is that it's very hard to maintain margins, and although turnover may be up because there is more volume coming through, it's not necessarily leading to a bottom line because everything is moving around in terms of costs, what they can charge and their rates and fuel costs. There is an interim impact, obviously, in Australia of the reduction in for fleets and moving things around here, but that's not really impacting bunker. The other things that are impacting bunker and the cost of transporting ships around is the Australian dollar and world currencies, and then the supply. Thankfully, OPEC's opened up a little bit more, and each of the European countries and America are releasing their stockpiles to be able to try and alleviate some of these issues. In terms of the overall, I still think there's a focus on delivering and just getting through this uncertainty and the shifting landscape, which sort of from feedback changes every day, every hour, some days, and having to sit on the phone for extended periods. So obviously the lockdown in Shanghai, having another impact, whether all these issues recede and there's less, trying to get to a less work involved to do the same movements, but I suspect that's next year once there is more ships online and everything normalizes well in terms of the supply chain. That's obviously impacting retail, where we're hearing that retailers are ordering more stock to be able to have certainty that they have it available. Whether or not it's the right stock, they don't know, and that's driving a bit of uncertainty and working through working capital a little bit more than what they've been able to previously, when if they wanted to order 100 shirts, they could have it in 10 days. Now it's a guess that you might have it in 3 weeks, but you may have it in 3 months, depending on when it gets through the shipping structure. Property construction's obviously been popular lately, with ProBuild and a couple of other Queensland builders falling over. There's some first home buyers to keep some and there's obviously sustainability measures in there around the housing finance and investment, how that plays out, particularly in Sydney, which has been difficult for build to rent and other similar things just because of the sheer pricing structure of Sydney, and whether there is a way through to be able to solve a bit of the demand versus supply issue coming through. That will be on a market by market basis. There is a lot of infrastructure spending as well, so that might pad out any issues or slow down in property construction around individual units or houses. There's apprentice and training, again, up in the technology, which may be useful as well. The big losses there are still in supply chain, the increased costs. So there's no real issue, no real solution provided to that. The fuel costs will obviously provide a little bit of an interim win, so that it costs less to move fleets around and be able to get things done. The major things overall for them are, where's the first home buyers and other affordable housing is going to land, what impact that's going to have on the industry. Will that soften any downturn or any sort of reduction in demand and reduction in pricing in sort of two parts of the market? I suspect that the higher end of the market's probably not going to change too much. It'll be more the mid and lower end of the market which might soften. If home buyers, first home buyers, can come in there and support that, that may help. And it may slow down, but we may end up with some slower price growth overall. The overall issues that are around, that are going to be around for until completion of this current round of projects, around fixed price contracts, where costs now exceed all of the expectations. So there are subbies and builders effectively working for a loss at the moment because their costs have exceeded what they're going to get paid, and that's creating a lot of the tension in the industry at the moment. The greater flexibility around costs is needed, but that might be across the entire industry, and how that actually gets through in numbers and whatever else will be difficult, but possible, and has been done before and will be done again. It's just the mindset needs to change a little bit to be able to let the process go through, and eventually somebody's going to have to pay more, which is the end customer generally. Demand still seems strong though. It may change depending upon the next sort of phases that we're talking about, which is we discuss on the next couple of slides. So this is all, everybody's talking about these sort of things, particularly a lot of the economists that I have the fun of listening to. Supply chain delivery costs, as we talked about, they're creating pressure. Wages and efficiency, there's not a lot of efficiency in the economy at the moment, but wages are going up. So the previous times that we've had inflationary pressure, we've been able to bring through efficiency to be able to offset. So you're getting more for with the more wages, with the higher wages. I don't know whether that's possible at the moment because of where we've come from with COVID, and that may create more inflationary pressure. There's also so much capital available still, and it's still relatively cheap. A lot of that's coming out of super funds and investment structures. So that is driving values across acquisitions and whatever else, and driving prices up as well for certain things. That, and the government and RBA policies around spending money. If this was not an election right now, I think strongly the government would not have put through a number of the things they did. So this budget has created further pressure pushing upwards, and everybody would have seen the RBA taking patient out of its quote for the month yesterday. What that means from Uncle Phil in terms of timelines at the RBA, who knows? But we'll get to that now. So this is what was said in February from the RBA. So we're expecting, or GB is GDP was forecast to have grown 5% last year, and it's supposed to have grown around 4.5% in 2022 and 2% next year. Unemployment is supposed to sort of decline to 3.75% by the end of 2023. One of my economists who has a different view around the world and puts it in a very different way. So he's looking at US mortgage rates, which are getting to 5%, and saying, look, it is a very different market in the US, but expecting that the next year or two, that is very possible for us. So that would move the RBA rate up to about 2.5, 2 to 2.5, and the RBA are actually targeting 3.5, so that they actually have some flexibility to impact the economy going forward. I do like his quote around how things have moved around. I don't know whether pluck a duck economics is a real study, but if you look at their view in 2021 and where things were going to be, and now in April 2022, the cash rate hasn't moved. Unemployment's gone down from 6 to 3.75, and inflation's gone up from 1.5 to 4%. That, at an economic basis, does not make sense, and that is obviously going to play through at some stage, and we're going to have to make some changes. And I think even Uncle Phil at the RBA sees that coming now. He's pushing back against what he was expecting to make changes and interest rate increases next year. It's now evidently going to be this year at some stage. But what does that all mean? The good news is the economy's growing and it's creating more jobs. The concerns are the increases in costs, transport and wages, and all of those other pressures that are driving the inflation. So, and the RBA sort of tasked with keeping inflation within those boundaries of 2 to 3% per annum. So at the moment, we're well over it, and I don't think it's going to slow down. A lot of these factors are not short term, but they're more medium term. So they're going to need to be managed to keep things under control. There is also the underlying issue around trying to keep housing affordability and all of those sort of things in there as well. Nobody really talks about it, but bringing interest rates up may put the brakes on that growth, which has been over 20% in 12 to 18 months. So I wouldn't be surprised if we get something in June around an interest rate, and that might only be 0.25, but they may go 0.5 early and then gradually wind it up by 0.25s. They want to get to 3.5 in the next 3 to 5 years so that they can have an impact, so they can pull it down to reduce, to try and put more money in the economy, or they can put it up to try and tighten it and keep that going. But if you look at it, a retail rate in 5% will be interest payments at 2.5 times what you're going to have to pay on a 2% rate now. So that's going to have a material impact on a lot of people and reduce the ability of spending or the capacity to spend, and also maybe run down some of these savings that we have. So the underlying issue under all of that is, if rates go up to that level, what impact will that have on the property market and on confidence? Because that will dissipate some of the impact, or that may bring down the inflationary pressures. It may not. So the unintended consequences, bank and finance and other facilities increasing costs. The banks make more money when rates are higher and they charge you more. That's relatively obvious. It could drive further increases in cost of goods and services as business protect margins and return. It's subject to competitive pressures. So it can become a multiplying effect where people go, yep, that's fine. I will cop the inflationary pressure of my costs and I'll just pass it straight through. And that continues to multiply, and the ultimate consumer keeps paying it. Some businesses will be able to sustain, or will not be able to sustain the investment or make businesses more sustainable. So there obviously are a number of businesses coming out of COVID who are still trying to work out how they work going forward, and interest rates might just be the final thing that breaks the camel's back and says, no, I'm out, and makes it too hard. That may also lead to a lot of consolidation and acquisitions and whatever else, which is the logical thing that should occur. But that may make it difficult for a number of these smaller businesses or businesses already under pressure. And what does it mean for longer term growth? Well, it's around confidence, and whether that means that businesses still can still get confidence even though there's an inflationary sort of position coming through. And the counterbalance to that is what happens with supply and workforce. What if we can't fix those issues and we create more problems, or those problems continue to accelerate? When do we actually get an inflationary pressure decline? So when does that switch off? And if there is a decline that happens too quickly because everybody goes, okay, I need to be, I'm concerned here, and the concern results to more conservative sort of approaches to business, then there's a potential economic correction and maybe a proper recession that may need to be managed carefully. But that would be, I would have thought, 3 to 4 years out. And that's where the concerns of a number of businesses now look at doing their forward planning once the uncertainty dissipates out of COVID, are thinking about where they get to, particularly if you're doing things like property developments where they could be completed in 3 to 4 years' time, and also looking at new businesses, expansion plans, and all of those things where it does take 2 to 3 years to be able to get through the process to get it out there. So one of the things we'd like to ask in the poll, with the election next month, increasing costs, lingering supply chain and worker availability issues for a number of industries, we'd like your thoughts. Are you going to ride through based on your forecast plan and adapt as needed, which is pretty much the COVID sort of approach? Invest and pursue growth on the basis the inflation issues will take care of itself and you'll ride that out, or just put investment on hold until there is more certainty. And the final one is a bit of a mix of everything. Is there a little bit of each of the above, but it'll be impacted by the right staff and equipment, which is obviously another issue. So if you have a look at that and give us your view. A and D are the joint champions, 35% each, but it's a pretty good spread. So that's interesting. Everybody's, I think, very aware of it and watching it. And it's going to be an interesting 6 weeks and probably until 30 June.